help us unpack the global market space, we join now in Cape Town by Arthur Karras. He's a senior portfolio manager at Old Mutual Investment Group under MacroSolutions. Good to have you with us today, Arthur. Maybe let's pick up on the FOMC meeting, which is no doubt well underway. Your expectations as to what Janet Yellen and her team might reveal to us?
Well, we don't think there's going to be any substantial change. You're going to have a lot of careful reading of the minutes of the sentences of what she's saying every time to see if there's any change in the language. I think the last time around we were led to believe that there would be a considerable wait before we were going to see higher interest rates, and I think people will be carefully analysing what she says to try and determine whether that's being moved forward or back at all. So the current expectation is for interest rates to start moving up about the middle of next year, but her words are going to be carefully analysed.
Just out of interest's sake, Arthur, is there any are there any pressing issues that will see them hike up interest rates a lot sooner than expected? We know tapering comes to an end this month. If we see positive GDP figures coming out of the US for the next couple of quarters, will that play an influence at all?
It will. I think the CPI number that you spoke about earlier, I think that's a sign that that would push out higher interest rates. But I think the critical thing that's probably been flagged by Janet Yellen already is the employment figures. She wants people to be back at work. She wants unemployment not to be a worry in the US before we start seeing higher rates there.
Let's turn our attention on to Scotland's independence referendum. With literally 24 hours to go before we hear that announcement. Your expectations as to how it will not only impact their economy, but their relationship with the rest of the UK and the Eurozone?
It's not really within our expertise to make a forecast there, but I think broadly speaking the details have not been hammered out yet. So there's a long list of issues that need to be decided on, not the least of which is what kind of a currency an independent Scotland will use. And all of these things are just negative for business. Business doesn't like change, doesn't like uncertainty, it doesn't like the idea of new sets of regulations or different regulations being injected into markets. So I think that's why you're seeing most big businesses saying they would prefer to see the union remain.
Keep speaking about the union. We saw UK unemployment figures, which were at 6-year lows, sitting at 6.2%. That tells us something about that economy, no doubt.
It tells us that things are getting better, and it's reminding us that we've seen the global economy at different speeds. So in the US, we're talking about when are they going to hike rates, but yet the same day we're seeing the Chinese central bank injecting liquidity into their economy, and we're seeing the expectation of quantitative easing in Europe. So different stages of growth or global recovery in different countries.
Let's explore that Chinese story, because there is much speculation that the central bank in that region will pump at least $81 billion into its top banks. Does it seem as though it's a desperate move from the central bank in China to help revive the capital stimulus in that region?
Not at all. I think that there is some expectation that they're going to provide some kind of a stimulus. I did see one commentator saying that he didn't think this was stimulus. He thought it was merely part of their normal provision of liquidity to the banks at seasonal times when they need a lot of cash. But I think the expectation is there that the Chinese can't allow the momentum in their economy to slow anymore, much more, and that they will need to provide some stimulus at some point.
We also saw disappointing manufacturing numbers out from China just this week, Monday, again highlighting the weak points within that economy.
I think that the issue for us back here in South Africa is that we're seeing a weak Chinese economy, so a weak consumer of commodities, and we're seeing a strong US dollar with the expectation that rates will be hiked there eventually. It means that an economy like ours could be stuck between a strong dollar and weak commodity prices, which would not be a good place for us to be.
So what impact does this have then, Arthur, on one's investment decisions, especially when you have exposure to global markets?
For us, it means the same thing it's meant for a while. It means that you want to ensure that as much of your portfolio as possible is exposed to the global economy or not exposed to the commodity-heavy South African index. So we're carrying about 25% of our portfolios in global equities, exposed to those parts of the global economy that we think will benefit from stronger growth in the US, stronger growth in the UK, and less exposed to the more cyclical commodity side where things are cheap, but the outlook isn't particularly strong.
Arthur, thank you so much for joining us to share your insights with us today. That was Arthur Karras. He's a senior portfolio manager at Old Mutual Investment Group.